Are you looking for a really cool earnings trade? Man, have I got a really good one for you. Tesla is declaring their earnings next week on October 22nd. And Tesla closed down a little bit on Thursday, around $429 per share. Here's a great trade for you. Now, I'm not here recommending trades, but I'm just opening your eyes to some really good opportunities that you might want to take advantage of. If you were to buy 100 shares when the market opens on Friday, you'd pay about $429 per share. You can, right afterward, sell a $430 covered call against those shares, expiring next Friday, October 24th. And guess what? Those calls closed on Thursday at $1,830. Here's what that means. I'm going to break it down super simple for you guys. You buy your shares at $429, you sell a $430 call that expires in 1 week. Now you keep the premium, the $1,830, no matter what happens. I'm going to say that again. The $1,830 is money that gets dropped into your account right when you make the trade. It doesn't matter where the price of Tesla goes. It could go up, it could go down, it could go sideways, it could go bankrupt. You would still keep the $1,830. Of course, we're not expecting Tesla to go bankrupt, and hopefully it doesn't, because if it did, you'd lose your money invested in those 100 shares. Now, one of two things is going to happen next Friday. Tesla's stock is going to be higher or lower than $430. If it's higher, you're going to sell your shares at $430. Now, don't worry. If Tesla has a really great earnings report and the stock shoots up, don't roll your call. Just let your shares get called away. The purpose of selling options is creating income for yourself every single week. If Tesla rockets up, you sell your shares at 430. That's okay. You paid 429, so you make $100, right? $1 per share times 100 shares. But most importantly, you made the $1,830, and then you choose another trade for next week. And if Tesla doesn't shoot up, let's say it goes down or it stays sideways, it's okay. You keep your shares. You only lose money on your shares if you sell your stock for less than what you paid. Don't do that. Historically, Tesla goes like this. So don't worry if it goes down. It should go back up again. And if Tesla does go down and you keep your shares, you can sell another call against those same shares next week. Now, a lot of times people will say, oh my gosh, that sounds really cool, Michelle, but what happens if the stock drops to the floor? What happens if Tesla goes to 400 or 350 or 300? You know what I say? Load the truck up. Now, it's important that you size your trades based on your account size, right? So if you have, let's say, for example, a $10,000 account, are you going to buy 100 shares of Tesla? Probably not, because you don't have enough money. But this trade is really good for someone that's got, let's say, 100,000 or a couple $100,000 in an account, because it is a more expensive stock. Now, when you buy the 100 shares, you can do one of two things. You can either have all the money to put up. So if you're buying 100 shares of Tesla and you're paying $429 per share, you need $42,900 in capital. Or you can buy on margin. And what that means is you're borrowing some money from the bank. Typically, if you're trading Tesla and you're using margin, you have to put up about 40%. So that would mean you'd have to put up about $17,000 or so. Now, margin comes with its own risk, because you don't want to have only, let's say, 17,000 in your account, because what might happen is if Tesla goes down and you don't have enough money in your account, it could trigger a margin call requiring you to sell your shares at a loss. So you don't want that to happen. Again, you want to position the stocks that you trade in your account based on the size of your account. And you have to also obviously make sure that you like the stock. Me, I love Tesla. It's been one of my favorite holdings for years. I know Tesla has a lot of volatility. I believe in Elon Musk. I love trading billionaire companies because I feel very comfortable that they're not going to go out of business. And so if Tesla does drop like a rock down the road and you have enough capital to invest, you can sell another put as the price goes down and get paid again. Also, after you get paid again, if and when you were assigned those shares, if the price of Tesla continues to go down, you're just averaging down your cost. So now you'd own, let's say, 100 shares at 429, and then you'd own 100 shares at a lower dollar value. That's a great trading strategy. Anyway, I hope this helps. If you like this video, smash the like button, subscribe to my channel. I'm putting up a video each and every single day teaching about selling puts, selling covered calls, walking through different tickers. If you're just getting started, I'm running a free live event in a couple weeks. I'll drop the details in the comments below. Happy trading.